All right. Good morning, everybody. We're going to get started. As usual, please do not be afraid to get up and get more food or move around or whatever you need to do as we get started. We might have some people coming in late, and that's okay too. So welcome. I want to start out. I know I've introduced myself to most of you. If I haven't met you before, I'm Jamie French, Jim's business partner. I have to start out with an apology. Because this is the second quarter in a row that you've had to listen to me. Jim fell ill at the last minute last time, so I was here last quarter. I'm here again, so I apologize that that's the case for you guys. I've gotten a little ribbing from the team. You might look around and say, you know, the attendance is a little less than normal, and my team has made it clear that they think that's because I spoke last time. I would like to believe it's because I did such a good job that there are some people that just have no further investment questions ever. So I don't know what the truth is, but we'll see. But thank you for being here. I want to, before I dive into all the investment stuff, I want to address an email that a number of you might have gotten that might be raising questions. So if you have any variable products with Thrivent, then you will be receiving an email asking you to sign some paperwork. And in fact, if you've seen them, you actually received an email and then a retraction of that email and then another email. So a little bit of a stumble, but here's what I want to let you know. Very little is changing as it relates to you. The impact on you is almost nothing. Behind the scenes, there is a change taking place in terms of the broker dealer that we work with. In essence, when we became independent and when Advent Partners was formed, we changed our broker dealer to a company called PKS. We are now going back to Thrivent Investment Management. It's largely invisible to you. It all happens behind the scenes, so there's really no impact to you, but we do need to have you sign those forms. If you get them, your spouse may also, if you're married, your spouse may also be getting those forms. So just be watching out for that. You'll be able to click through to sign them, and that's what that's all about. So I wanted to try to head that off. If A, you've seen it and been confused, which rightly so, and B, if you haven't seen it yet, please be looking for that because we will be needing to get that paperwork back from you. Okay. If you have any questions, we can talk after the fact. I don't want to take a lot of the time today on that, but I did want to mention it because there may be a number of you impacted by that.
And Jim did send out a little explanation
Yes.
email.
Yes, yeah. So thank you, Dee.
So we got that.
Yes. I don't know if you knew Dee's working for us now, apparently. That's great.
Yeah.
Yes, thank you. That's a great point, Dee. Yeah, we did send out an email trying with a video trying to explain a little bit what's going on. So thank you. I forgot about that. So great. Okay, so as you probably remember, how many of you have been to one of these economic updates before? Just about everybody, if not everybody. Okay. So you might recall from the past, we got lots of charts and that might lead to lots of questions. And it's funny, you know, some people love charts. Other people, they look at charts and they kind of feel a little bit lost. And even as I'm presenting sometimes I look at a chart and I'm like, what's going on there? And oftentimes I feel kind of like this. Here's a chart that shows you what you might see if you looked at a mountain range through a tennis racket. So there may be times today where I put up a chart and you might have a question and I might be thinking, well, it's a mountain range. I don't know, but I'll answer your questions the best I can. I also want to mix it up a little bit today. Normally I present some information, you ask some questions. Today, I'm going to be asking the questions. And what I mean by that is I'm gonna quiz you a little bit, but don't worry, I have rewards for those who participate and have good answers. And those rewards come in the form of some confectionery treats. I do want to let you know, I might need some help passing these out. So Chris and I guess Jeremy's not here, but Chris might help me with this. But I do want to point out that I have diversified my candy portfolio between Hershey's and M&M Mars. So if anyone is partial to either of those, but Chris is gonna serve as my Vanna today. If you have a preference, if you answer a question and you want a piece of candy and you have a preference, you know, certainly we will let you swap and get the kind of candy that you want. All right, so I'm gonna start right off with a question. We often start our presentations looking at some data. What is one of the measures that we look at to determine kind of how the market is currently valued? Is it pretty rich? Is it discounted? What is one of the measures that we look at? PE ratio. Excellent. He gets a prize. Yes. So the price earnings ratio, which just reflects what's the stock price compared to the earnings of that company, and we look at it for the S&P 500. Follow-up question, when we look at that PE ratio, what do you think is the 30-year average, the ratio of price to earnings? Any guesses? I don't expect anyone to know this. I wouldn't have known this if I wasn't. 16. Well, you're very close, but you're wrong. It's actually 16.65. Well done. Well done. Yes. I can see Barry's going to be getting a lot of candy rewards today. Okay. And so here's the last question. So if the 30-year average is 16.65, where do you think the S&P 500 is today? 22. 22? Any other guesses? That's a good guess. Okay. You're a little high, but you get a prize anyway. The number, as of when we put this information together, 19.98. And so if you remember, we look at, here's where we stand today. And the 30-year average is here right in the middle, and we're slightly above one standard deviation above that. So, and that's with, you can see, probably at the end of March, we were actually a little higher, and actually, Chooch, we might have been around 22 at the end of March. It's since come back because we have had some more correction recently. So the market is still valued pretty high. When I look at that, we'll look at some of the history, but that doesn't necessarily mean that the market's ready to drop, okay? When you look at this, certainly, when have we been high before? Well, you can look back here in 2020, we kind of dipped way down and then, had a lot of growth and came way back up, and we're quite high during this period of time. But I can also look back, anybody remember 2008? Yeah. Well, in 2008, oh, I hit the wrong button. In 2008 here, the PE ratios really weren't that high. And even before 2008 happened, like late 2007, they really weren't that high. So this isn't meant to be a 100% predictor of what's going to happen, but it does give us an idea of the relative strength of the market. Okay, but we also know, and we've talked about with the S&P 500, that it's heavily weighted towards a smaller number of stocks. So I want to ask another quiz question. What percentage of the S&P 500 is represented by the top 10 stocks in the S&P 500? When you look at the weighting, what percentage of the S&P 500 is just the top 10 stocks, if you had to guess?
Is it like 90% or 80%?
It's not that high, no. Lower than it's sub 50. You're very close. Prize for that man. And I'm sorry I forgot your name. Rich. Thank you. Thanks, Steve. Yes. So currently it's about 33.5%. So if you look over here, the weight of the top 10 stocks in the S&P 500 is about 33.5%. What's really interesting and why we look at this is if you look at this chart over here. Oh my goodness, I got to use the right number of the buttons here. When you look at this over here, I just said that the S&P 500 PE is around 20, but the top 10 is actually closer to 27, and the rest of them are around 17.5. Okay, so we've experienced, and you can see here, this green line represents the top 10, a lot more volatility in those top 10 stocks that represent 33% of the S&P 500. And that's why, you know, as we're building portfolios, you have to be careful about just saying, oh, just invest in the S&P 500, because that's not maybe as diversified as it used to be. Okay. The good thing is that when we look at the earnings of those companies, you know, these don't align perfectly. You can see, you know, the percentage weighting has increased dramatically. This has come up, but it's also the earnings have come back down. So in a perfect world, we see a little bit more alignment. It's not too far off, but there is a difference there. So the market is, you know, the market and particularly those top 10 stocks are sensitive. Now, within that top 10, we have what's referred to as the Magnificent Seven. Has anybody heard that term lately? The Magnificent Seven sounds so regal. So I have another quiz question. Who can name any of the Magnificent Seven? Facebook, Meta. Yep. Facebook is now Meta. Google, Facebook, Google. Yep. Nvidia. Yep. Apple. You guys are crushing it. You're missing a couple. Oh, you're missing one that you're missing two. Well, one is okay. Tesla. Yep. Good. TikTok's a good answer. It's not one of the Magnificent Seven. It's one of the mediocre 12. No, I don't know. I don't know what the next. I don't know what the next grouping is. Where do you guys do a lot of shopping? Amazon. Yes. Yes. So I think you hit oh, there's one other one. We have Apple. What's the other big, long-standing technology company that rules the world? Yes, Microsoft. Good. You got them all. To make sure we get prizes for everybody there. I heard a lot of answers there. So when we drill down from the top 10 to the Magnificent Seven, again, you can kind of see how much volatility there is in those Magnificent Seven compared to the other S&P 500 stocks. Okay. What's interesting too, when you look at earnings growth, earnings per share, you can see how those compare and how the blues, the green section has come down in terms of earnings per share, right? And then the other thing is, again, even within that Magnificent Seven, there's quite a dispersion in performance. This chart at the bottom here is showing you kind of the best of the Magnificent Seven and the worst in each year. These are some pretty wide ranges of returns, right? Look at this year. The best was a 239% return. The worst was a 48. In 23, the best was Nvidia, and the worst was Apple. Worst, I say worst. They were only up 48%, right? And then what's that? I thought I heard a comment. And then this year, Nvidia is again up 67%. Tesla is actually down. Now that I think they've recovered a little bit more recently, but so again, just an understanding of the impact of a small number of stocks on the overall direction of the S&P 500. Okay, so time for another quiz question. What percentage of the time, roughly, is the S&P 500 year? Like if you look at it year by year by year, what percentage of the time is the S&P 500 positive versus negative? You had to guess. 60%. Who said that? Jeremy, good. By the way, I did forget to say that employees of Advent Partners are not eligible for prizes. Yeah, he does. Yeah. Well, we'll see. We'll see. Jeremy is close. Jeremy is close. It's around basically about 3 out of every 4 years. So around 70-75%. What is the average drop within each year? What's the average drop in the S&P 500? What percentage do you think in an average year? What's that?
I thought it must be 30.
30? It's sometimes 30. That's not the average though. It definitely can hit that. So the average drop, the gray bars represent, returns in the S&P 500. So you can see 33 out of 44 years on the chart are positive. The average drop, the red, represents the worst drop within each year. The average drop is 14%. So if the S&P 500 drops by 14%, you kind of shrug and be like, that's an average year. Ho hum. By the way, I know it doesn't feel like that. But that is an average year in terms of volatility in the S&P 500. All right, let's talk about, we always try to touch on, you hear about recession. I read an article yesterday, some people say we're already in one, or there's one coming. So we look at certain factors. I'm going to ask you another quiz question, but I'll tell you, if anybody knows any of these answers, you deserve like a king size candy bar because this is a harder one, but we sometimes talk about the 4 horsemen of a recession. Okay. Certain indicators that we look at to determine, is a recession on the horizon? Does anybody have any guess as to what those might be? Bond inversions. That's a great answer. It's not one of the 4 horsemen, but yes, a lot of people look at the yield curve and say, if the yield curve is inverted, that's an indicator of recession. That's a great answer, Barry. Not one of the sectors that we're looking at, but yeah. All right, so I'm going to show you. I was going to say, if anybody gets any of these, I would be. If anybody got any of those, I might be hiring you. I don't know. So here's the 4 sectors. So first of all, residential investment, business investment, light vehicle sales, and business inventory to sales ratio, like how much inventory is sitting around not being sold. Okay. And what you can see here, the blue lines on each chart represent the long-term trend or average. The gray line, the gray squiggly lines represent where we've been. And as you can see, kind of across the board, there's the risk of recession is fairly low. And if we do experience one, it's probably going to be pretty mild at this point in time. And so that's just one of the things that we look at when we talk about recession and, how close are we? All right, now I've got an easy quiz question for you. This one's easy. You can all answer it. I shouldn't preface it that way because then there's the pressure of, well, we better get it right. All right, this is a true or false. True or false? We should trust our feelings when making investment decisions. Okay, you're laughing. That's good. This is good. We have an educated group here. I'm glad to see that. Why do I say that? Well, this next chart shows consumer confidence and the stock market. And the first thing I'll point out to you is this chart measures how confident is the average consumer or is the collective consumer. And so, if we're up here, that means the consumer feels really confident about things. If we're down here, the consumer feels really not confident. And you can see, when we look at the next 12-month returns from when the troughs in confidence were, it's a great time to invest. It's a great time. If you're feeling really not confident about the market, it's a great time to invest. The average return from those 9 sentiment troughs over the next 12 months was 24%. Now, here's the interesting thing. The average return from the peaks was still positive too, 3.5%. So this is the chart that says, don't trust your feelings, right? Take a disciplined approach. And this shows you where we are today. Like we were at the bottom in June of 2022. That doesn't surprise anyone because 22 was kind of a nightmare in both the stocks and the bonds. But that's climbed back up, still below the average, but we've climbed back up. That doesn't mean anything about where the market's going. It's not a predictor, but it's always interesting to look at. And I know that a lot of this is impacted by what we see and hear on the news, right? Like there's always commentary about what's going on in the market. There's always people that say the sky is falling. Sometimes I wish the media would simply say something like this. Stocks plummeted today to a near record low because that's what they do sometimes, right? Like that's just the nature of the beast. And so when I think of consumer confidence, I think of that. So, question. That's a good question. I don't know the scientific, I know they do regular surveys. I don't know the firm that does them, but they do regular surveys of investors. Has anybody ever gotten one of those? I don't know the mechanics of it. I know they've measured it for years, but I don't have a better answer for that.
Does the University of Michigan do that? Yes, they do.
Well, there you go. Chris Van Hart's our resident expert on consumer confidence surveys. So there, I learned something today. Thank you.
That's come out on one of the weeks that I did the weekly market update, so that's. I
About
didn't
that.
say that, I was Buckeye.
Yeah, so can you really trust it?
Yeah.
Yeah.
Can't even say the name, right?
Right.
So I toured the Ohio State facility and the stadium at one point, and I don't know if anybody knew this, but they remove all of the M's in the entire stadium, like they cross them out or remove them.
Yes.
And no M's allowed. It's quite funny. Okay, so I want to turn our attention to some of the economics. Again, I do not pretend to be an economist, but we do like to touch on those things. I want to talk first about the labor market, and we're going to talk about, what does the labor demand look like and what does the labor supply look like? And so this kind of shows you, in terms of job openings, we peaked in March of 22. That's come back, but there's still, a significant number of job openings relative to where we've been in the past. Quits are on the decline. You can see a little trend here that those are abating a little bit, and non-farm layoffs are at an all-time low. They're creeping up a little bit since 20, but still, fairly low relative to history. So that's kind of a picture of like what kind of demand is out there for labor. What about the supply side? Here you can see non-farm payroll gains. So this is something that is, new jobs is paid attention to by the Fed in terms of how's that going to impact inflation? How's that going to impact then their decisions on interest rates? And you can see largely, this has trended down for a significant period of time since January of 21. A little bit of upturn here recently, but certainly a slowing in terms of labor supply. The good news is that you are seeing over here, this is looking at the labor force, breaking it out between foreign-born and native-born. And you are seeing, if you look at the blue section, you are seeing more people entering the workforce coming from other countries. You're also seeing that in the younger demographic, age 18 to 64, I say younger. So you can see in age 18 to 64, that has recovered, but in terms of the total labor force, it has not recovered quite as quickly. Okay. So why do we cover that? Well, that's an impact on, what kind of consumer spending is going on, which impacts inflation, which impacts interest rates, which impacts the markets, particularly the bond market and the stock market to some extent. So that's why we like to look at that. So that brings us to inflation. This is just kind of taking a look at where we are with inflation. Again, peak back here in 22. It's come down here below our, normal long-term averages. You can see in March of 24, headline CPI at 3.5% compared with a 50-year average of 3.8. And then you can break it down. Core CPI is basically inflation without food and energy. Food and energy are both a little bit lower. So that's just a kind of a picture as you're listening to the Fed, and actually today the Fed is making an announcement, I believe. So we'll see what's going to happen with that. But that's a little bit of picture into what's going on with inflation. And then in terms of what makes that up, like what's impacting inflation, this talks about the different categories of inflation. And so you can see, back in 2022, energy was a huge component of that, but that's come down dramatically, right? Energy, so your, gas and transportation, things like that. But shelter continues to be the big inflation driver. It's stubborn. Prices in the area of shelter are not coming down as fast. And, when that occurs, I think that, the core CPI will, continue to drop further. And then we look at kind of breaking down sort of the other category. And what I wanted to highlight here is this red section, which is auto insurance. And Prior to auto insurance, it was transportation services. And you can see the gray and then the red. And again, that probably doesn't surprise anyone because how many of you have either held off on buying a new car or know somebody that, new car prices are high, thus the insurance on them is high. There's a lot of new technology in the cars, so the cost of repairs is more. And so auto insurance is an area that has, again, been increasing in inflation over the last several months. So those are some of the key components as to why, if you're wondering, hey, when's inflation going to come down? Those are the areas that are kind of stubbornly hanging on. Okay, another quiz question. We're gonna switch to, obviously whenever we talk about inflation, we talk about interest rates. So I want to switch to another quiz question. What do you think is the single most important factor that drives interest rates, that drives the Fed's decision on interest rates? What's the single most important factor? What's the measure that they're looking at? Real estate? It's a good answer. I'm going to come back to that. Employment, yep, they definitely look at that. We mentioned inflation, obviously. So this is, what's that, magic 8-ball? So this is common knowledge on our industry. It's not necessarily known to you, but the single most important factor that determines interest rates is actually the height of the Fed chairman.
Oh,
So this is a history of our Fed chairmen. Paul Volcker back in the late 70s and 80s. Remember what interest rates were like back then? He was 6 feet 7 inches tall. And then Greenspan came in. He was just under 6 foot. Bernanke was a little shorter than him. Janet Yellen, our shortest Fed chairman in recent history. And you can see the interest rates were low. And then our current chairman, Jerome Powell, came back in. He's another 6-footer, and the interest rates rose as aggressively as they ever have. So I actually hesitate to put this in here, and we put these online. It's like I hope people aren't actually making decisions based on this. But I thought I would share a little levity. But it is interesting when you look at kind of the history of interest rates. This does kind of look like that chart that I just showed you, right? You can see the tall, and it doesn't exactly line up. But the bottom line is we are at, we have had significant increases in interest rates over the last couple of years under Powell. And, again, Fed's meeting today in the late part of last year, the Fed came out and said, hey, we think next year we're going to start reducing interest rates. And then, some data came out in January and February on inflation. It was kind of like, maybe that's not going to happen this year. So it remains to be seen. Certainly for conservative investors, they like the fact that they can go to their bank and get 4 to 5% now. But that makes it challenging for the bond market. And that's what we're going to talk about next is, the bond market. You might recall in 2022, we had double-digit losses in the stock market, but we also had double-digit losses in the bond market. And I just kind of hinted at an answer to one of our quiz questions coming up. But what do we talked about valuations of the stock market? What do they look like for the bond market? So this is looking at yields across several different types of bond sectors. And so the gray bar represents the 10-year range, like high and low. The purple, kind of light purple color, is the median for that period of time. And the blue is current. And so what you can see is almost across the board, yields in the bond sector are well above their historical average. So what that means is you can get meaningful yields, you can get attractive valuations and some income protection in the bond market right now. And part of the reason for that is because of what we saw happen in the bond market last year, which brings me to my next quiz question. Prior to 2022, if we go back to like the 70s, what was the worst loss in the bond market in a given year, if you had to guess, percentage-wise? Worst loss in the bond market. Jeremy's ready. He's like my star pupil. Hey, he's answered questions. You're just handing out candy. Any guesses? Don't be shy. There's no wrong answer except for all the answers.
Talked about this, because this is when he was starting into this. It seemed like he answered this, that it was as low as when he was like one.
Yeah, you're right, yeah. So the worst loss in the bond market prior to 2022 was since like the 70s was 3%. Like 1 year we lost 3%. Can you imagine? In the bond market, and that was back in like the early to mid 90s. Does anybody know how much we lost in 2022? I already hinted at it. I said it was double digits.
20%.
Not quite, but close. 13%. This chart has it all. Do you see the sore do you see the sore thumb on this chart? And here's the thing. In the stock market, we had a really bad 2022, but 2023 recovered quite nicely, and 2024 started out really well too. The bond market, because interest rates went up so dramatically, the bond market was hit pretty hard, came back some, and then has given some of those gains back. So until those interest rates come down, we're probably not going to see good returns in the bond market, but that's also why valuations in the bond market are somewhat attractive. Right? They're cheaper than stocks right now. Okay. I want to shift my attention to international stocks. We don't talk a lot about this, but we do like to touch on it. Typically, we see international stocks and domestic stocks. They kind of go in cycles of outperformance. So for a period of time, you can see here in the gray sections, the US market is outperforming international markets. In the blue or purple, whatever color you would call that, the international sector is outperforming. And you can see up until this point in time, you kind of had maybe an average of, 5 to 7 years of that cycling, international versus domestic. What you've seen more recently is we've got a 14-year run here in US markets. And so what I'm going to highlight is if you look here at this little, start to this period here, about 2 years of tracking, and we look back here, this looks like a lot like the start of another cycle of international outperformance. And so am I telling you to go put all your money in international? No, but what I am saying is the US market is pretty highly valued. It's the S&P 500 is driven by a few large companies. And so we always talk about diversification. Why do we do that? Well, valuations in the international markets, valuations in the bond markets, those are a little bit more attractive right now than say the US stock market. I'm just looking to see if there's anything else. Yeah, so what do valuations currently look like in that area? Well, first of all, when we look at global earnings are an important, we talked earlier about price to earnings ratios. So earnings are an important component of performance. And you can see here that really, with the exception of China, we see earnings kind of trending upward. And when we look at valuations in these different categories, you can see again that largely across the board, here's the US. You might remember these numbers from earlier, but across the board, international sectors are at or below their long-term averages. So clearly a little bit more of a discount in those areas than today. What about global economic activity? This is kind of looking at the purchasing index to kind of see how things are going. Surprise, surprise, red is bad, green is good. Okay, if you can, that's about the extent of my knowledge on this chart. Red is bad, green is good. But you can see in different areas, we look at, so there it is. We look at like global total economic activity, manufacturing services. Then we break it down into domestic markets and emerging markets. But across the board, you can see a lot of green, or you can see orange where there was red. Okay, so things in terms of activity and potential future earnings and in essence, the global economy, things are trending upward on that side of things. And then if you remember back to sort of post-COVID, there was this big concern about the supply chain, right? We all heard about the supply chain and delays in the supply chain, and that was affecting global economic activity, which was affecting our investments. And So I just wanted to kind of give you an update on that as well. There we go. Yes, that's it. So again, this is looking at US imports, and again, with the exception of China, we see imports to the US from these other categories trending up. But here, back in 2021, we were talking about 65 days delay on delivery of services and goods globally. That's come down well below the average and certainly well below the peak. Here we're at about 49 days. So a lot of improvement in that area as well. So given all of this economic data, what should we do about it? How should we act? How should this impact our investment decisions? I'm going to share this with you. I'm just going to let it sit and let you enjoy it. This is what you maybe don't want to do. Psst, hey, bud, want to make some easy money? I hope this doesn't sound like me, by the way. Just give me a few $100 and I'll invest it for you in some top quality Happy Days memorabilia. You'll triple your investment in no time. I don't know. Frankly, this sounds like a Fonzie scheme. Any Happy Days fans?
Yeah.
All right. So I wanted to, full disclosure, I put this in here purely for the grown value. I saw that. I'm like, yeah, that's not necessarily how we want to act or what we want to do with our money. But obviously, we always talk about diversification. We've shown you this chart before. It kind of shows all the different asset classes and how they've performed and how they've ranked versus other asset classes over time. But the white one in the middle that you kind of can see highlighted is kind of that mixture, that balanced portfolio. And what you see is strong performance over time with a lot less volatility. What's interesting about this chart is typically if you look at this over a period, it goes back to 2009. Typically, if you look at it for a period that long, you're not going to see, like, look, I want to highlight the green. You see the like this light green color that's consistently at the top. That's your large cap stocks. Remember that 14 years of outperformance that I showed you? That's not typical. And so, again, diversification becomes really important, especially when stocks are valued as high as they are. We've talked a lot about valuations. This is just looking at valuations across the board. So again, this is going to sound familiar, but we have kind of the different types of bonds down here. And when we look at their valuations relative to history, looking pretty attractive. International stocks looking pretty attractive. Small caps, kinda, but then we get into like the US stock market, you can see well above historical averages. So similar message to what I've already shared. The other thing that I hear sometimes from folks is it may not be a good time to invest because we're currently at all-time highs, right? Like we're currently at all-time highs, probably wait, let's wait for a correction and then invest. Logically makes a lot of sense, but this is a really interesting chart. So this looks at all-time highs over here and market floors. So the green represents when there was an all-time high that kind of set the floor, right? As opposed to then coming back down. And you can see those periods. Here's what's interesting though. If you look over several periods, the gray bars represent if you invested on any given day. Okay, and what the returns would have been. And the green represents what it would have looked like if you invested at the next high point. Okay, and what's interesting about this is the returns are very similar. And in some cases, in the 1, 2, and 3 year periods, it was actually better to invest at an all-time high. Why is that? This was curious to me, right? The reason for that is because when the stock market's doing well, it tends to have all-time highs in bunches. And so it's kind of like a new all-time high begets another all-time high. And so the kind of logical and maybe to some degree emotionally driven decision is, I better wait, like the market's really high right now. But generally speaking, do you remember what I said earlier about the stock market? What percentage of the time is it positive? Like 3 out of 4 years, right? So doesn't that mean like statistically we're kind of always setting all-time highs? Right? So just a reminder to maybe not fall into that kind of thinking. And again, you've seen this chart before, but this looks at comparing just the green represents just a stock portfolio the blue represents just the bond portfolio, and the gray represents a 60-40 split between the two. And that's not to say everybody should be 60-40, but it's just an example of the value in having a balanced portfolio. And when we look at that over the 5, 10, and 20-year periods, you never had a negative return in a diversified portfolio. You might have in an all stock or an all bond portfolio, but you've never had it in a balanced portfolio like that. So again, just a reminder to stick to a disciplined plan. All right. One last question. And it's another true or false. In an election year, it is wise to use political discourse to influence your investment decisions. Okay, good. You guys are great. I gotta be honest, as I was preparing for this, I could have come in here and just shown you slide after slide of what does the market look like in different, what does it look like when it's a Republican presidency and a Republican Congress, and what does it look like when it's split? What does it look like when it's just Democrat? And in looking at a lot of different charts, one of the things that I realized, and this isn't going to surprise anyone because it's kind of true anytime you're measuring something, is I can use a chart to tell you anything I want to. But I do want to show you one political chart, and I primarily want to use it just to pick on all of us. Okay. This chart is showing consumer confidence by political affiliation. Okay, what does this chart tell? And this goes back to the Bush years. So what does this chart tell you? Well, it basically tells you that if you're a Republican, you feel confident when there's a Republican president. And if you are a Democrat, you feel confident when there's a Democratic president. I will say, I'm going to pick on both parties here for a second. And I'm going to use a couple of Winnie the Pooh characters to do it. When I look at Republicans, for example, they are really happy when a Republican is in office, and they are really upset when a Democrat is in office. Like they are like Tigger from Winnie the Pooh. They're up and down, right? Like when Republicans in office, they're all excited, but they're up and down. And then if I look at the blue line, and again, I'm picking on everybody here, but when I look at the blue line, Democrats are just always unhappy. Like they never get too high. Like, so who are the Democrats like? Yeah. Of course, I'm picking on everybody, and but my point in that is we don't rely on what you are listening to. Don't rely on the noise. Like, yeah, if you're Republican, you're probably going to feel better if there's a Republican president. But going back, do we rely on our consumer confidence when it comes to investment decisions? No, we do not. So our encouragement is stick to a disciplined strategy, ignore the noise, turn off the TV if you need to. And just remember, election years statistically do tend to be more volatile. It's like you can look back at history, and one thing you can say is they tend to be more volatile because people are more volatile in election years. So be the people that aren't volatile and stick to a good disciplined strategy. And obviously, if you're wondering what you should be doing and you're not sure, that's what we're here for. We're here to help you stick to a long-term strategy that'll help you meet your goals. And that's all I had to share for today, unless you had other questions you want to ask. You guys did a great job answering questions, so give yourselves a hand for that. We will be around if you have other questions. And again, if you had questions about, that broker dealer transition email, we can talk about that too. Thank you. Oh, I missed a very important part that I cannot miss. I'm going to flip through these disclosures so you can read all of them, speed read all of them. I think there's 7 pages of them, just so you know. Oh, there we go.